In this video, we're going to talk about the carry trade and explain how it works. Stay tuned. Hey traders, a very warm welcome to you. So what is the carry trade? What is it all about? How can we make money from it? Where's the hidden risk in it? How does it work? Where have people been caught out? Let's look at the whole deal. Right. See my little example here. Let's dig into it and explain what's going on. So if we can imagine we have a country that's called country A. So it's A land, Aville, whatever it may be. And the interest rate for that country is 1%. Interest rate being set by the central bank. And it's basically what you would get on your money if you invested in that country. So in other words, every year you're going to get 1% back on your money. Now we look over to country B. They've got a bit of a different scenario with their economy. For whatever reason, they've set their interest rates at 7%. So in other words, you're receiving every year 7% interest on your investment. So getting that payment every year, or it might be every month, whatever it may be. The point is it's annually. So you can see now we've got this country that pays 7% for investing in them and this country that pays 1% for investing in them. So how do we profit from that? What's the carry trade? How does that profit? How do they profit? How do people who are doing the carry trade profit from this kind of scenario? What someone will do is they will say, okay, I want to borrow money in this currency and I then want to invest it in this currency in this country, because I can borrow at 1% and I can invest it at 7%. So they will borrow some money here, a figure of money, they'll convert it to this currency. Let's say they convert it at 2 to 1, whatever that exchange rate may be. They will then invest that for the year, for the period of time, and this is what happens. They are paying a 1% on their interest on the balance here that they owe for country A, but they're receiving 7% interest from investing in country B. So now they've received it. Let's say if they've done a year, they're at the end of the year, this is what they say. They say, hey, you owe us 1%. These guys say, thanks for investing with us, here's 7%. Now they'll take that money, they'll convert it back, assuming they can get the same exchange rate. And this is a big assumption we'll talk about in a second. Assuming they can get the same exchange rate, they convert it back. They've got their underlying initial capital plus 7%. They pay back the initial capital that they've borrowed plus the 1% fee, and they've made a nice 6% profit on the deal. Very nice. And if you consider if they add leverage to that, 10 to 1 leverage, for example, maybe a bit excessive, but 10 to 1, you're going to be making 60% on your money. Decent money to be making. Just some kind of terminology. The short, or the currency with the low interest rate that we're borrowing, is the funding currency, or the short currency. Or that's the one being used to fund the other currency, and that was called the long or the carry. So we fund in low interest rate and we carry in high interest rate, because that's when we want to get the money out of and pay back the one that's in the low. So all very well, all very nice and looking very good. And also a little extra thing we like to see as well if we're trading the carry trade is the appreciation of that carry currency. So in other words, you know, versus, again, obviously it's got to be against the one that the funding currency, but we want to see that ultimately we're getting a bit better interest rate when we're converting it back, because the carry currency is appreciating versus the funding currency, meaning that, you know, it's going to benefit us when eventually we exchange it back the other way. So we get a double whammy, hopefully. Now, obviously you can see where this breaks down, potentially where it breaks down. It potentially breaks down in a couple of areas. One is if the interest rate changes. So if all of a sudden the interest rate changes and this goes up to, you know, kind of 5%, say, and this comes down to, you know, 5%, all of a sudden we're not making anything on our money. And actually, with a little bit of spread, probably extra, if we were going on doing this in the real world, we're not making any money until we probably lose money. But of course, the biggest way that we can lose money is if this interest rate changes against us and goes against, sorry, not interest rate, if this exchange rate goes against us and really damages the trade. And actually, we saw this 2007, 2008, the yen carry trade unwinding. You know, if you get a big kind of depreciation of the carry currency or an appreciation of the funding currency, then this will undo all your gains and you end up losing on the actual exchange rate itself, on the speculation you've got on the exchange rate, as well as potentially, you know, if the interest rate changes. And actually that will fuel, the interest rate changes will fuel the currency move that you don't want anyway. If you start to get this going the other way from 1 to 7 this way, then this is going to really adversely affect the exchange rate for you, and that's actually what is going to nail you and nailed a lot of people with the carry trade. Okay, so if we can imagine now, we'll put some examples in like US dollar and yen. If you can imagine, let's go back to our initial example here where we had 1% and then we had, I think we had 7, didn't we? Let's just say, for example, that that's yen, and that's it could be US dollar. It wouldn't be at the moment, obviously, but it could be Australian dollar, for example, or something with a high interest rate. So because we have that scenario, you know, we're literally borrowing in yen and then we're buying our long AUD, Australian dollar, receiving 7% on our Australian dollars, converting it then back, paying off our yen debt. We've got a nice amount of money left with our initial position. So that's the carry trade. How can we do it as a retail trader? Very, very difficult from a retail trader's perspective, because the reason we can't do it specifically, obviously we would just be buying AUD JPY, for example, if we wanted to do that carry trade. But the reason we can't do that, generally speaking, as a retail trader, is the spread isn't as good in terms of the interest rate spread. Yes, we're going to receive 7%. Yes, we're going to pay 1%. But generally, if we're going with a retail broker, they're not going to give us 7%. They're going to give us way, 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 way less. And they're going to charge us way, 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 way more. So ultimately, even though you might be receiving some funding every day, and actually you get paid it every day, that's the whole point of it as well. You get paid a daily fee. You might get something for it. Ultimately, it's not going to be worth it as opposed to if you did it in an institutional environment, because even institutions now are thinking, oh, it's not so good, I've got to be a little bit cautious. It works very well. We've got a nice static environment and everyone's chugging along and no one really that bothered about risk, and it just everything sort of kind of the economy is moving, or everything's moving. There's no significant moves in interest rates and it's all very easier to predict. That works very nicely. When you get an unpredictable environment, it becomes a little bit more dangerous because you're exposed to this adverse currency movement. And as a retail trader, if we were trading AUD JPY, like I say, we're not going to get the full 7% here. It's going to be, you know, way, way less than the 7%. We're going to be paying way more than 1%. So we're not going to be receiving anywhere near that arbitrage technically between the two that we would do if we went on the interbank. So it's a kind of a challenging thing for us. Let's say, for example, we did find somewhere and we went kind of direct to one of the bigger players and we did this. Theoretically, we could actually do this trade. You know, the logic is there, we can understand it. We could pick a higher currency here, we could pick a low interest rate currency here, whatever that may be at the current moment in time. We'd have to obviously extrapolate out and think where interest rates may go. What we don't want to be doing is kind of shorting or using a funding currency when they're just about to kind of hike interest rates up. It'd be a bad place to be getting involved in the carry trade. It's vice versa as well. So, you know, there's a lot of kind of prediction that comes with it, and you've got to be very cautious about how we're doing it, and obviously being aware that this can become quite a crowded trade. And just finally, something that happened quite a lot over in Japan is we had a lot of Japanese kind of families, or housewives as they would call them, who would be doing this. They would be borrowing loads of yen and they would be going out there and buying loads of Australian dollar and pocketing the difference. And we had just literally so many people doing it. And of course, when it unwound, everyone's caught on the wrong side of it. It's like everyone trying to get out of through a very small door. So that's the basis of the carry trade, guys. You're making the money on this interest rate and you're hoping to also make interest rate differential, and you're hoping to make money on the appreciation of the carried currency too. Anyway, guys, take care. Good trading. See you soon. Bye-bye.